Welcome back. Today, the U.S. Census Bureau and Bureau of Economic Analysis announced the international trade balance figures. The deficit was reported at a $70.6 billion level in July. That's down $10.2 billion from the revised $80.9 billion in June. The balance of trade, again, is the difference between exports and imports. The negative number is, certainly something we see every report, but a smaller than normal or a smaller than prior negative number is actually good news. And in other news, a Hungarian foreign strengthened in anticipation. Hungary will set up anti-corruption authority to oversee spending in the European Union. Now, looking to the trade balance numbers, we see left center over here, the numbers actually moving up. That's a good piece of news because the deficit has decreased to some extent. However, the long-term trend for this is very much to the downside. I don't know if this represents anything more than a blip on the screen. We do see here the trade balance numbers. That's a negative 70 billion. That's better than the prior June report of negative 80 billion. It's actually the best number we've seen in quite a while, about 9 months or so. Really briefly, looking at the FX market, we can see here the Hungarian foreign HUF. It has a 53.5 RSI reading, which is really lackluster. Doesn't really reflect a very strong level, but we can see on the next chart it's actually the strongest currency, or the biggest change I should say, to the upside in the past 24 hours. The Hungarian forint as of yesterday had a 41 RSI. Now this jumps to 54. That's a pretty dramatic move in just one day's time. So it'll be interesting to see if this trend continues. The weakest currency, or the currency that lost the greatest amount of capital overnight, was the Japanese yen, which typically has a very low interest rate, and capital moves into it under a flight to safety. But with equity markets strong today, traders sell the Japanese yen in light of higher yielding currencies. Now, moving to the bond market, very interesting turn of events. Top right hand side, red line represents total bond yields. That's all the different bonds and their maturities added up together. The blue line represents the S&P 500, which did have a nice day today, back to the upside, and we see a little blip to the downside. Yields did contract. Now, just to clarify, it's very misunderstood at times what the inverted bond yield curve is. We have a 30-year bond, or actually better example, the 10-year bond has a 327 yield, and the 1-year bond has a 360 yield. Typically, under normal economic conditions, we tend to see longer-term maturity bonds have higher interest rates. However, when traders are nervous about the near-term future, for example, 1 year ahead, they'll sell the short-term bonds and buy long-term bonds. When they sell the bonds, bond prices go down, bond yields go up. Think about it this way. The bond market has to offer us higher yields in order to attract investors when traders are not buying the 1-year bond and the 2-year bond. So traders are buying the 10-year bond in lieu of a lot of others that have lower, smaller maturities. And because they're selling these bonds, those bonds, like the 1 year, have to offer higher interest rates. Now, with that said, there was, for a very good amount of time, a very strong correlation between the S&P 500 and the spread between the 30 and 20-year bond. As the S&P 500 goes up, then the spread on the 30-20 bond market also increases. Taking a look at it this way, we see here the 30-20 spread and the S&P 500. The S&P 500 is a black line. The orange line is the difference between the 30 and 20-year bonds. Now, this is a negative number, this orange line. This shows us the inversion, but the inversion seems to be blipping up to some extent. Now, it's not moving exactly in the same fashion as the S&P 500, but there's still a fairly strong correlation. But notice a difference now between the S&P 500, the black line, and the yellow line, which is the 10-7 spread. The difference between the 10-year bond and the 7-year bond, which is inverted. The 7-year bond has a higher yield, has a higher interest rate than the 10-year bond. But that inversion has decreased to some extent. That has really exploded, meaning that it looks like we're reaching for, or we're heading at least in the direction of a little bit more normalcy. We're still inverted, but it's a little bit less of an inversion. Now, this could just be short-term market fluctuations. I don't know if this is a sign of improving conditions to come or not. But what's interesting is the orange line over here, that's an orange area chart. That's the S&P 500. Today we had a nice blip up. The green line represents the difference between the short-term bonds, the 6-month to the 1 year, the 1 year to the 2 year, etc. Now, going back to June, when stocks went down, this green line went up. Why? Because traders were selling the short-term bonds. They were buying longer-term bonds as a flight to safety. That's when the inversion really kicked in. That's what we would expect. But why is it that the S&P 500 goes up and this green line is going back up, while at the same time the blue line and the red line, which represent long-term bonds and medium-term bonds, medium terms like a 7, 10-year maturity, long-term bonds are the 20s and 30s. Now, why is this happening? It doesn't really make sense, at least historically, to what we've seen. Typically, when stocks go down, like in June, short-term bond yields go up. Stocks go down now. Why is it that short-term bond yields are actually blipping higher? One of these cannot stand. So it'll be very interesting to see, and especially tomorrow, Federal Reserve Chairman Powell, I believe, will be speaking. And the last time he spoke in Jackson Hole, Wyoming, it certainly did rock the markets, as he indicated higher interest rates are pretty much a certainty. With that said, we'll have to see, especially after he speaks, will the bond market resume course? Meaning, will traders start to buy the short-term or buy the long-term bonds and sell the short-term bonds? If that's the case, we would likely also expect to see stocks go down. If stocks go up, I expect to see short-term bonds rally. I expect to see this green line go down. So there's a little bit of a divergence in the charts right now, and that really does present us with an opportunity. Because typically if we see a correlation, a very strong correlation, we can say, okay, well, stocks are going down and the inversion continues to increase between the 30 and the 20 or the 10 and the 7. But when that inversion breaks, it either means we're reversing course across all macroeconomic fields or one market just hasn't caught up. I happen to think it's the latter. Take a look at the yellow line again. That's the inversion between the 10 and 7 spread. That hit a bottom going back to August 30th. Did this predict the stock market rally we saw today? Or was this just a blip higher? Maybe the stock market's reacting to that in part, and maybe we'll see a regression or a return to what we expect to see are constant trends, meaning stocks are down and traders are selling short-term bonds, and this yellow line would respond accordingly. So all that we have to see. And I think tomorrow, with the Federal Reserve Chairman speaking, I think that certainly could be a catalyst for some big market moves. We hope this has been helpful. We look forward to seeing you back soon.